of confidence. In our February 2007 seminar, I used the graph that's on page 11. The graph comes from an article in the New York Times. It's not the greatest reproduction of it here, which was done in August 2006. And the data come from Robert Shiller, Yale economist. And cracks had begun to surface, obviously, in the residential real estate picture by that point, but most experts were characterizing the problems as containable and essentially restricted to just a segment of the market. Now, we're not real estate experts by any means, and you'll hear later from somebody who is, but we understood, and we do understand now very well, the concept of value. And it was clear from this and other data that we were certainly in a real estate bubble. A bubble that would end badly, and we made that argument, and the bubble obviously has burst. If you look at that graph, the real estate, and this is inflation adjusted from 1890 or so. And so you see it stays, I mean, this was Depression era and so on, and it dropped there, but there's a constant running through there. To see something like this, why that doesn't scream to people, this is an anomaly that probably will not stand, is hard to understand. Anybody who knows cyclicality of markets, but for reasons that probably belong more in Susan's bailiwick, analyzing the psychology of investors, we didn't want to address that point. And I'm not relating all of these earlier forecasts just to pat ourselves on the back. Contrary to Alan Greenspan's famous contention that you can't identify bubbles before they burst, we did point out, before they burst, the extreme danger of all the bubbles of the last dozen years. Debt, derivatives, stock valuations, technology stocks, and housing. And our clients haven't been hurt by any of them. Along the way, well, thank you for that was not, I wasn't calling for it. Along the way, we've been characterized by a number of people as perma-bears, as gloom and doomers, but we've been right. Stocks are down for the decade. We've been intermittently bullish, but we've seen the rallies of the last 10 years to be rallies in a longer-term bear market environment. And we're looking forward to being long-term bullish when stock valuations are cheap. And we readily admit stocks could certainly go up from here, but they're not cheap. So markets move on things other than fundamentals much of the time, but we tend to stay fairly close to the fundamentals most of the time. Now, to get into a discussion of the prospects for inflation or deflation, we have to see how we got here. The explosion of debt led to the bubbles that I just discussed. And when each bubble burst, the government's answer was to reflate the economy to avert a debt collapse. Now, that resulted in bailing out banks and other major financial firms, including the government's own Fannie Mae and Freddie Mac. And in rescuing everything that has been categorized too big to fail, the government has essentially transferred hundreds of billions to trillions of dollars of debt from private balance sheets to the public balance sheets. Now that means that you and I and our children and our grandchildren and probably our grandchildren's grandchildren will be responsible for repaying the debts created in the various bubbles. When the average person looks at that situation, the common response is that it's probably going to result in a declining US dollar and increased inflation, because the government will probably print lots of money to pay off a big part of the debt. And it may well happen that way. But there are other considerations that could change the picture dramatically, and I want to highlight some of those as well. Let me take a minute before we get into it further to define inflation and deflation. Now, most people simply think of inflation as a condition of rising prices and deflation a condition of falling prices. Technically, inflation is the increase in the volume of money and credit relative to the available amount of goods. And deflation would be a contraction of the volume of money and credit relative to available goods. Now, price inflation, which is what most of us think of as inflation, is normally the effect of money and credit inflation. They normally go together, but they don't have to go together. For example, over the past year and a half, we've seen tremendous inflation in money and credit, particularly credit. Tremendous amount of money was made available to the banks, but it hasn't been circulated through the economy. It's sitting as reserve deposits in the banks. So that's certainly credit inflation. There's no question about that. But we haven't seen a substantial transfer of that credit inflation into the price pipeline. We haven't seen any real surges, with very few exceptions, in price inflation. Now, page 12 shows you the picture of price inflation over the past 6 decades. From about the mid-1950s, say down here, I suspect that's inflation with the Korean War, but from about the mid-1950s up to 1980, we saw a pretty steadily rising rate of inflation, price inflation, as measured by the CPI and the core CPI. And then, since 1980, we have seen the reverse of that. We have seen with the bounces, but largely a decline in inflation for the better part of the last 30 years. Now, the red line on this graph is the CPI, the Consumer Price Index. The green line is the core inflation, which is the CPI less food and energy, which are excluded in core because they are supposedly so volatile. Most of the time they run pretty close together, as you can see just looking at the graph. And over the past year, the CPI, which is a little above here, is at 2.3% rate of growth, and the core inflation rate is at 1.1%, getting very close to actually showing some deflation. We can also look at inflationary trends at various stages of the production pipeline, which you see over on page 13. This, in various sections of this, shows the pipeline of how goods move from crude goods to intermediate goods to finished goods. And here is the overall CPI down at that's the core CPI down here at the very bottom. But you can see up here that the current reading on crude goods, basic materials, is the one that has bounced the most. This is up 44.5% year over year, admittedly from a very low base. It had gotten, as you'll see on a later graph, the commodity prices had gotten mashed down to terribly low levels, and so the bounce since then has been substantial in percentage terms. So you've got a big 44.5% increase in crude goods year over year. A much more moderate 4% increase in the intermediate goods, and a much, much smaller, less than 1% increase in finished goods. So far, this price surge is being borne by businesses.